So yesterday saw the release of the latest Bank of England Money and Credit Report covering February 2024. So let's just dive into the detail and have a little look at what the numbers might be suggesting about the mortgages and the personal credit situation in the UK economy right now. So if we just take a brief look at the overview and the key points. These monthly statistics on the amount of and interest rates on borrowing and deposits by households and businesses are used by the bank's policy committees to understand economic trends and developments in the UK banking system. So the key points: individuals borrowed on net 1.5 billion of mortgage debt in February, compared to 1.1 billion of net repayments in January. Net mortgage approvals for house purchases rose from 56,100 in January to 60,400 in February, and net approvals for remortgaging also increased from 30,900 to 37,700 during this period. The effective interest rate, the actual interest rate paid on newly drawn mortgages, dropped by 29 basis points to 4.9% in February. And net consumer credit borrowing decreased to 1.4 billion in February from 1.8 billion in January. So those are the key points. So if we take a look at these in a bit more detail and focus on the mortgage lending numbers. So as you can see, individuals borrowed on net 1.5 billion of mortgage debt in February, compared to 1.1 billion of net repayments in January. And this was the highest borrowing since January 2023, when it was 1.9 billion. The annual growth rate for net mortgage lending continued to be slightly negative at minus 0.1%, which is an improvement on the minus 0.2% that we saw in January. And gross lending rose from 17.1 billion in January to 18 billion in February, while gross repayments decreased from 18.5 billion to 16.7 billion over the same period. So as I have said in other content that I've produced, we are starting to see a little bit more activity in the market right now. And these numbers are an indication that that's what's happening. I think this is primarily for two reasons. One, because interest rates have started dropping, which in itself is generating a bit more activity. And two, because we're actually starting to get buyers coming back to the market after acknowledging that we are now going to be in a higher interest rate environment and just having to accept that, and actually looking at the affordability numbers and then buying within their means rather than overextending themselves as people did previously when debt was so cheap. So people are starting to get used to the new affordability calculations, what their money can buy for them, and then just acting accordingly, because if you need to buy a property, there's never a better time than now. So going back to the data, net approvals for house purchases, which is an indicator of future borrowing, rose from 56,100 in January to 60,400 in February. And that's the highest since September 2022, when it was 65,300. Net approvals for remortgaging, which only capture remortgaging with a different lender, not product switching with your existing lender, also increased from 30,900 to 37,700 during this period. And this goes back to, again, other content that we've produced, where up until recently, most people were having to stick with their current lender and just do product transfers because they didn't meet affordability calculations. We're now starting to see a bit more competition back in the market, with lenders trying to attract new borrowers. So hopefully this is an indicator that things in this area are going to be improving going forward as well. Moving on, if we go down to the consumer credit information. So net consumer credit borrowing decreased to 1.4 billion in February from 1.8 billion in January. This decrease was mainly driven by lower net borrowing through credit cards, which fell from 0.8 billion to 0.5 billion. Net borrowing through other forms of credit, such as car dealership finance and personal loans, also decreased slightly from 1 billion in January to 0.9 billion in February. And the annual growth rate for all consumer credit dropped from 9% to 8.7%. The annual growth rate for credit cards and other forms of consumer credit both decreased to 11.9% and 7.3% in February, respectively. So this seems to indicate that people are getting used to the new higher interest rate environment and actually don't want to borrow as much money on credit cards, and instead are choosing to try and start to repay some of that debt, which is a good sign about the strength of the UK economy and the fact that people are actually starting to feel like they have a little bit more money in their pocket and they're trying to use it sensibly rather than by spending, which is kind of backed up by the next bit of data, which covers household deposits. In February, household deposits with banks and building societies rose by 6 billion, which marked the fifth consecutive monthly increase. This was mainly driven by flows into interest-bearing sight deposits of 3.5 billion in February. Flows into non-interest-bearing accounts increased from a negative 3.5 billion in January to 0.2 billion in February, while flows into time deposit remained weak at 0.1 billion. So again, to me, these numbers are suggesting that people do have a little bit more money in their pocket. Obviously, I appreciate that we are still in the middle of a cost of living crisis and things have been more expensive, but things have been slowly improving. What I would also suggest that this means is that people are now starting to think more cleverly with their money, and rather than getting more credit, they're actually trying to save money, and they're seeking out the best savings accounts and trying to earn money off those savings by shopping around, because there is increased competition between the banks and building society who are trying to attract savings deposits from new consumers. So whilst we are still seeing the effects of the cost of living crisis and a lot of people not having as much money in their pockets, there are people that are now starting to find that they've got more money in their pocket. Could be due to all the wage rises and things that we've seen, reducing inflation, the cost of food starting to come down, and hopefully these things are only going to get better when the energy price cap reduces as well. So it does feel like the economy is starting to turn a corner, which is why I've been saying that I do think, despite the fact that mortgage rates are higher and cost people more money nowadays, people are actually starting to be accepting of this, getting used to the new numbers and borrowing within their means. So I do honestly believe that the housing market in the UK this year is set to improve. But what do you think? Please let me know your thoughts in the comments, because as always, I'm really interested to know how things feel on the ground for you, the consumer.